Hi everyone. My name's Connor Reid. I'm one of the financial planners here at City Asset, and I'm joined by Ross McKnight, our senior investment analyst. Ross, it's been a while since we last spoke about the CAM sustainable service, and I thought it might be helpful to give a general overview and an update for those clients who are interested in these kinds of green investments. So, first of all, would you just remind us of the origins of the service and how long we've been running it for?
Yeah, thanks, Connor. So the sustainable service, as it is today, was set up in early 2022 on the back of increasing client demands. And before this, we did run a what we would call a sustainable light service, which was done on a best endeavors basis. The key change now is that we do our own in-house ESG scoring on all of the investments that we use in client portfolios. And we get the data for this scoring from a number of sources. One would be the asset managers themselves. Two would be from sources such as Morningstar, and there are a number of other inputs that we use in our scoring.
Right, so it does take a different approach to our core service, which doesn't have those kind of scoring. So maybe could you just spend a minute telling us the difference in how the two services run?
Yeah, absolutely. Yeah. So the investment process itself is exactly the same until we get to the point of selecting the investments. So we still take top-down views on a range of asset classes. And then when we get to the level of reflecting those views through our fund selection, that's where it differs. So in our sustainable portfolios, I mentioned before about our ESG scoring from 1 to 4. And to get into the sustainable service, the investment must be at least a 3. And what we mean by a 3, to give some context, is that the investment must have stated sustainable objectives, and other things it might have are things like negative screening, where certain parts of the investment universe are excluded on ESG grounds. And another thing that's quite typical is sort of positive engagement. So the fund management team engaging proactively with companies to improve the environment or societal benefit.
So I guess that would be one of the key objectives for someone who wants to invest in this kind of service.
Yeah.
So those are the differences, but are there any similarities between the core service and the sustainable, or is it two completely different approaches?
Yeah, so maybe I'll take our Rail 4 mandate as an example. So this is our most popular mandate at City Asset Management. So the crossover between the core Rail 4 portfolio and the sustainable Rail 4 portfolio is around a quarter, or to be exact, it's 24% as of today. The first main area that there's a lot of similarity is within our alternative income assets. So these are things like wind farms and sustainable infrastructure. So we use these in both core and sustainable mandates, and they're obviously providing a good societal benefit and environmental benefit. The other area where there's significant crossover is within our government bond allocation. So this is quite a contentious issue in the sustainability world, because some people say that, governments fund wars and do other bad things, and obviously on the flip side, governments do a lot of good for the world as well. So when we set up the service, we felt that the benefits outweighed the negatives. So we include government bonds in our sustainability portfolios. So those are the two key areas of crossover. So as you can see, it's sort of 75% of the traditional funds aren't used in sustainable. But again, I would just come back to the point that at the headline asset allocation, it's still the same. We're just using different investments to reflect those views.
Right, that makes a lot of sense. And when thinking about the clients that I speak to, everyone's got their own objectives, things they want to try and achieve from their portfolio, whether it's from growth or specifically sustainable investments. So it might be helpful just to talk on exactly what we're trying to achieve with this sustainable service.
Yeah, yeah, no problem. So the objectives of this service are the same as our traditional service, with the added benefit that your portfolio is delivering benefits to society and or the environment. We are aiming to deliver real returns for clients over the long term. So these are returns in excess of inflation. The reality of the space is there are certain sectors that are excluded. If you think about things like oil and gas, defense stocks, being two examples. So this means that all else being equal, sustainable portfolios don't have the same degree of diversification as traditional. It's not to say they're not diversified, but there are certain investments that they can't be in. So we would say that we think the destination is going to be the same, but the journey might be slightly different. And what you find in this space is the returns tend to be a bit lumpier than in our traditional mandates.
Right, okay, because we've seen a lot of volatility over the last few years, several big events in markets, which have impacted regular investments. But how has the performance been for sustainable investments over the last few years?
Yeah, so maybe I'll go back to 2020 and just sort of give a bit of context over the last few years. So 2020 was a great year for the space. Ultra low interest rates and excitement about rebuilding the economy using green energy were two of the big drivers. Since then, with the exception of 22, which there was an energy shock and these investments did quite well, they have suffered, particularly in 23 and 24. There are a number of reasons for this. Both the magnitude and the speed of inflation and interest rate increases were two of the big ones. There have been certain cyclical pressures. Companies have actually struggled to get enough labor, for example, and enough skilled labor. That's been one of the big issues. And then in sort of the recent time, we've seen in the States Donald Trump pushing back on ESG and cutting renewable subsidies. So these have all sort of negatively impacted the space. The final point I would make is the nature of the companies in the sustainable universe. They're more early stage and they're higher growth. So when interest rates rise as quickly as they do, these companies have a much higher cost of financing, which has disproportionately hurt these companies relative to more larger traditional assets.
Right, it's quite interesting to hear all the different different factors you need to take into account when looking to invest sustainably. You mentioned there about Donald Trump and his D&I pushback. Are there any other? I mean, I hear sustainable in the news all the time. Is there anything that we should be aware of right now? Anything that's developing?
Yeah, it's a great question. So what we've seen as of late is there were certain subsidy programs in place in the States where if energy developers did renewable projects, they got things like tax breaks, etc., to kind of incentivize them to build these projects. So what we've seen as of late is a lot of these subsidies have been scrapped, again feeding into the narrative of Trump pushing back against ESG. And actually, what we saw, I think it was 2 weeks ago, was Ørsted, who are a wind project developer. They had a project that was 80% completed off the coast of Rhode Island in the States, and Donald Trump just pulled the plug on that. So is that likely to continue? We think there is the risk that some of these projects may be pulled on a forward-looking view. What I would say though is that the Europeans have gone the opposite direction. They're doubling down on ESG and they are pushing ESG more than ever. And it makes a lot of sense because wind and solar are the two cheapest sources of energy. So it's not just a political goodwill point. It actually makes economic sense as well. So there's kind of the US, there might be a few issues to come, but we're really encouraged by what we're seeing in Europe. And actually in 2024, there were record wind auctions in Germany. So there's loads of new renewable energy projects that are going to be built out over the next few years.
Sounds quite promising, really. And that probably leads me on to my final question, which is probably the hardest question of the video. What does the future look like? What are we expecting? What do we think sustainable investment will do in the short to medium term?
Yeah, so on a long-term view, all of the structural growth drivers are still in place. We still need to do the energy transition, and we as a firm believe that as the environment unfortunately continues to deteriorate, these sustainability issues are going to be, it's going to be more about the economic impact rather than sort of a political goodwill story. So we think that's to come, and we also think, you know, AI is the buzzword at the minute, and the amount of energy and water needed for the AI build out is off the scale. So, you know, that is another driver for renewable energy sources, for example. In the sort of short to medium term, we think things are likely to improve. We've got globally an interest rate cutting cycle. You know, you see this sort of in the US, the UK, Europe, and some of these cyclical pressures that we touched on earlier are improving. And on a company level, when we look at the companies themselves, in 2023 and 2024, companies had negative profit growth. And in 2025, we've seen companies actually getting back to growing their profits. So that's really encouraging. The other thing we're seeing is that companies are becoming more shareholder friendly. They're doing more share buybacks and more dividends, which is good for shareholder returns. So from a pure fundamental investment point of view, we think the space looks good on a forward-looking basis. And we've also got the added benefit that with your capital, we are investing and helping both the environment and the society advance in a sustainable way.
Right. Well, I think that's probably enough of an update. So thank you, Ross. That was really helpful, really interesting to hear. If anyone has any more questions, then please get in touch and we'll do our best to answer them. But thank you for your time, Ross.
Thanks, Connor.
All right. Take care.